Have you ever wondered how certain traders appear to know just when to join and exit the market? We're going to reveal those trading secrets today. Traders, welcome back. In case you're new here, click the subscribe button and let's explore the intriguing realm of trading together. Have you ever had the impression that you are using the market as a chessboard, but you are missing certain important pieces? What if I told you could actually accomplish those moves? Watch this space as we unveil expert-level entry and exit tactics that will revolutionize your trading style. We'll discuss the entry and exit points in profitable trading in this video. The best part is that by the end of this video, you'll have practical knowledge that has the potential to significantly increase your trading success. Stay put, you're in for a spectacular treat. Also, get ready for an exciting announcement, and trust me, you won't want to miss a single moment of this video. We've got a special surprise lined up just for you that's guaranteed to elevate your Forex knowledge. An exclusive gift is up for grabs, so buckle up and get ready to seize the opportunity. You won't want to let this one slip away. Do you understand entry and exit points? Entry points resemble rocket boarding permits. When you think the stock is poised to explode in value, that's when you want to jump in. Regarding exits, see it as knowing when to get off that rocket before it descends. It's all about timing. Prior to acting, first consider how the market is going. Is the trend positive or negative? Will there be any news soon that might influence the market? You can trade efficiently by providing answers to these questions. I hope you understand how important it is to have a clearly defined entry and exit strategy in place. It is just as crucial as choosing the appropriate investment plan. An exit strategy helps investors lock in profits and reduce losses, while a well-thought-out entry strategy helps investors decide when it's appropriate to enter the market. Regarding entrance and exit tactics, there are a few different schools of thought. Which trading style works best for you? While fundamental analysis concentrates on the examination of the underlying financial and economic factors that influence the market, technical analysis makes use of charts and other tools to investigate past market trends and patterns. What are some possible approaches to creating a reliable entry and exit plan for your bearish market strategy? Let's check. Number 1. Choose your place of entry. You should be well aware of the circumstances that will lead to your market entry before you enter it. This could be a specific technical indicator, a specific price level, or a mix of the two. If you use technical analysis, for instance, you can search for a head and shoulders, double top, or triple top pattern, which are bearish trend reversal patterns. You can then position your entrance point at the pattern's neckline after the pattern has been recognized. Similar to this, if you're utilizing fundamental research, you might search for signs of a recession in the economy, rising jobless rates, or falling company profits to enter the market. Number 2. Decide where to stop losing. A stop loss is a fixed price at which you will pull out of the market in order to minimize your losses, because it shields your capital and keeps you from hanging on to losing positions for too long. Setting a stop loss is essential. Number 3. Set a profit objective. Setting a profit target will help you lock in your gains, just as setting a stop loss would help you limit your losses. This is particularly crucial in erratic markets where circumstances might shift abruptly. If you're enjoying this video so far, please leave a like and subscribe if you want to continue learning more about the world of Forex. Drop a comment below too if you have any questions regarding this video or anything else Forex related, and I'll get back to you as soon as possible. But first, tell me, have you ever tried breakout trading? What was your experience? Recognizing breakout trading, mastering points of entry and exit. The breakout trading approach has been a source of fascination for traders for a considerable amount of time. This is a trading method that involves detecting important points on a price chart and then capitalizing on a significant increase in price either above or below these strategic areas. Traders that employ the breakout technique seek to capitalize on the robust momentum of the market in order to generate substantial returns in a very short period of time. Within this section, we will delve into the complexities of breakout trading, covering a wide range of aspects related to the understanding of entry and exit positions in order to maximize trading performance. Recognizing chances for breakouts. Do you recognize the chances for breakout? The foundation of breakout trading is the identification of breakout opportunities. Technical indicators and past price data are frequently used by traders to identify possible breakout moments, using levels of support and resistance. It is one well-liked technique. Resistance is a price level that a stock or market has historically avoided beyond, whereas support is a price level that it has historically avoided falling below. Through observation of these levels, traders are able to predict possible breakouts. Furthermore, technical indicators that help validate breakout indications include moving averages, Bollinger Bands, and the Relative Strength Index known as RSI. Assessing quantity and verification. Volume analysis is essential to trading breakouts. Strong market participation is indicated by sudden price movements and substantial trading volumes, which validates the breakout. When a breakout occurs, traders frequently search for volume spikes to verify the legitimacy of the price action. In general, a breakout with strong volume support is seen as more dependable than one with little trading activity. This differentiation is essential for separating genuine breakouts from bogus signals, which improves the trader's ability to make decisions. How important time frames are? The selection of the time frame has a significant impact on the level of success that breakthrough trading achieves. Opportunities for quick, small-scale breakouts can be found in shorter time frames, such as intraday charts, which are accessible to day traders. When compared to shorter time periods, longer time periods, such as weekly or daily charts, display larger and more regular breakout moves. This makes them a perfect choice for swing traders or position traders. A trader is required to select the appropriate time frame, which is determined by their trading style, their level of risk tolerance, and the conditions of the market. By adapting trading strategies to a variety of time frames, one can increase the variety of trading tactics. Examining trends in volume for entry and exit points. Have you heard about volume trends? Volume trends can help traders decide when to enter and quit trades. As an asset approaches a breakout level, traders look for increasing volume to find entry points. This volume rise may reflect market consensus and give traders confidence to enter. Be cautious and don't buy based on volume. Volume analysis with other technical indicators is best for trade validation. Points of exit. Trade entrance and exit timing are key. The optimum time to leave depends on volume. A trend may lose momentum if volume drops after a breakout. This may indicate profit potential. Stop-loss orders help traders protect their money from trades that go wrong. How important is the moving averages and MACD indicator in entry and exit? When making entry and exit decisions, some traders rely on volume and moving averages. The 50-day and 200-day moving averages are useful tools for identifying trends, as well as support and resistance levels. It is possible that a breakout will occur if the volume crosses these moving averages. There is also the MACD indicator, which is a well-known trading tool. Moving averages and divergence are indicators of entry and exit points in the market. Conversely, a positive crossover with increasing volume may imply a trade, while a negative crossover may indicate an exit from the market. This is where I need your feedback, traders. What method do you always utilize to enter and exit the building? You can start some great conversations by leaving a comment below, and together we can get things started. Don't forget to subscribe to our channel and enable notifications to ensure that you never miss out on important information if you're looking for additional trading tips and tactics. It's finally here, the moment we've all been waiting for. Prepare to discover the amazing present we've carefully chosen just for you. If you stayed and watched the entire movie, please leave a comment below with the word "free" to receive our unique gift. Thanks for watching.